Hey, welcome back to The Dive. Today on the show, we're joined with Peter Grandich. But before we get into it, hit that subscribe button for me, please. Hey, Peter, welcome back to The Dive.
Good to be back.
Okay, so Peter, on July 5th, you announced in Pete Speaks to call you Petrified Pete going forward. It's been about 3 weeks since this announcement. Are you still petrified?
More than ever. And I actually, last Friday, for the first time since before the pandemic started, actually took a short position for my personal account in the US market. And I just believe that we are in the most latter stage of the biggest bubble of all time. Uh, my position may or may not work because they may be able to extend it past how long I could hold that short position. But I just think there's just an ever increasing number of bearish reasons with none or very little reason to be long general equities and general bonds in the US for any time soon.
So gold is seen as an inflation hedge. Do you believe a rate hike by the Fed would make it less appealing? And how do you believe this will affect the non-yielding metals prospects?
Well, first of all, I don't know if we're going to get dramatic rises in interest rates because the Federal Reserve is kind of trapped by if they raise interest rates too much, too fast, they can kill the people who have gotten used to what I call monetary heroin, and that is very cheap money and very low interest rates. Also know that although this is a little bit of a different period, interest rates rose throughout the 70s uh, up to almost 21%, and gold still managed to go up several $100s. So I don't think I'm not fearful that a few interest rate rises kills the rally that I continue to expect in the gold market. So I'm not really worried about it, and I don't really think it's something that the market is priced in or is going to prevent anything from going higher.
So given all the monetary stimulus in the US over the last 18 months, what are the long-term consequences of the Fed's policy?
Well, as I said, this monetary heroin is just like real heroin. It's hard to get not used to it. And every time there's a little blip down in the stock market, Wall Street acts like a bunch of addicts and cries for the Fed to come back and ease and stop whatever they're tightening or less accommodative. And eventually, so much money sloshing around creates tremendous bubbles. We've seen that in every area, including in the crypto market. Uh, I don't think if we ever had the monetary loosening that we've seen, that the cryptocurrencies could have gotten to where they are, but they have, and they need to be grateful for the Fed. So I just think that we've now opened Pandora's box. And of course, the biggest thing that comes from too much money is much increased inflation. And we're just at the start of that point now.
Yeah, Congress is set to vote on whether to raise or suspend the federal borrowing limit, which is the newest political minefield. Do you believe we have reached a stage where debt servicing will become a major concern?
Well, first of all, they will increase the debt limit. We go through this probably 150, 200 times already since we started this so-called debt ceiling, and it always gets raised. So I'm not worried about suddenly they don't raise it. I will tell you that what we have now is the inevitable crisis is the debt crisis, because in 2019 we had the best year we had from a government revenue standpoint. We took in over a little point $3.5 trillion. Our interest payments then were about 450 million dollars. If we go just back to 5%, and we now know that debt is hard debt is up to 30 trillion, and that doesn't include Medicare, Medicaid, and Social Security payments. At 30 trillion and 5%, we would have a 1.5 trillion dollar interest payment, or almost half of revenues just to pay interest on our debt. We're getting to the point where the can not only be not kicked anymore, but it's going to come back and crush a lot of people. So I think that's the next big crisis. It may take a few more years, but it's no longer a question of if, it's only a question of when.
Changing gears, how do you structure your gold equity portfolio? How do you generally weigh producers, explorers, etc.?
Well, when I was very active in that market, I was very active in the junior end, but because of where I am in the twilight of my career and how many years I've been doing this, my focus when I do get very active tends to be in major producers or at advanced stage exploration companies. That doesn't mean that early stage companies can't have an interest. The difficulty now is it's very hard for those companies to get not only capital, but people interested in them because of a variety of reasons from regulation to the pandemic impacting ability to see people face to face. So I would first say that I would err on the side of majors, then significant explorers, and the grassroots types of companies, which I basically totally avoid. I think only when we are at the latter stage of this gold bull market, which I think still is going to go a lot higher than $2,000 an ounce, then I would look at the pure grassroots play. So I would ever, like I said, with more advanced stage, well capitalized juniors, and of course the significant producers as well.
Okay, so what about the uranium sector? What needs to happen for uranium equities to leg up higher?
Well, I think it's the best. If there's no such thing as a short thing in investing, uh, but if there's a closest to it, I believe it's the uranium market. It is a perfect storm that has come together at a time when the whole world talks about electrification. Now all planes are going to be electrified and everything's going to be electrified, but no one's telling us how we're going to get that power because currently, just on the conditions we have now, we have rolling blackouts and inabilities to produce electricity. So if we are going to have electrification, which seems a, a certainty, we're going to need powers more than solar and wind and all. And nuclear plays that role, and it plays it at a time where the supply and demand scenario has never been better. So the next leg up will be when we see now as these contracts, these long-standing contracts that the utilities companies had with a handful of uranium producers are coming to an end and they have to go back and make new ones, we're going to see the spot price start to move up. And that'll be the signal for the overall investors to come in that market. That's still a market that really has been left to a handful of people that kind of watch it and been watching it. So I still think there's a tremendous amount of upside to that market. And to me, stocks like Cameco and all that are significant producers are really no brainers to own. Now, they may go down if the market falls hard, but I don't think they'll stay down like the rest of the stocks.
hmm Okay, so last question before you go here. We know you give advice to people in retirement. What advice do you give to people looking to keep up with inflation while minimizing risk?
Well, that's the biggest challenge right now. The Federal Reserve has killed the fixed income market by bringing interest rates down, and other central banks are guilty of that as well. And so, people who have retired or were hoping to retire and used to look at fixed income where pretty well the principal was safe, and hopefully the interest rate would keep them ahead of the rate of inflation, that really doesn't exist anymore. In fact, for the first time in history, something I would have told you never in my 38 year career did I ever think was possible, but even so-called high yield funds, junk bond funds, really what they are now yielding less than the consumer price index. So it is the biggest challenge now going forward in order to keep ahead of inflation of your purchasing power. I think people are taking substantial more risk. It's one of the things that maybe has helped hold up the stock market because people bought general stocks for dividend payments, but there's no certainty there. And that's the big problem. And I don't see how anybody could step up now and buy a 10-year bond yielding a little over 1% when we know inflation's 4 or 5%. That's an automatic loser right there. So that's the biggest challenge. It's not something talked about on Wall Street right now, but retirement planning is going through a very crisis. And it's really difficult now for people to try to be safe and still keep ahead of inflation.
All right, well, thank you so much for joining us on the dive today, Peter.
Thank you for having me as always.
Thanks so much for tuning in today. We'll be back again tomorrow with amazing new content, so be sure to stay tuned. Bye.